It's been a big week for finance, and to discuss it, I'm joined by John Kehoe, Economics Editor of the Australian Financial Review, and National Senator Matt Canavan. Great to have you both. Thank you so much for your time. Look, let's start with the RBA hiking rates for the 12th time this week, 12 rate rises. RBA boss Philip Lowe says that the wage rises, the Fair Work Commission approved rise in wage rises, would be fine if productivity is lifting at the same time, but there is a serious question over what the Labor government is doing or whether it's doing enough to lift productivity. John, why is this such an issue, and what can Labor do to actually play a part in any sort of quick time frame in boosting productivity growth?
Look, rising wages of around 3 to 4%, Sharri, normally when you're getting a bit of productivity growth is sustainable with the inflation target. But at the moment, we're starting to get an acceleration in wages and no productivity growth. It's been going on for about 3 years now. It's been a long, deep-seated problem even before that under the coalition government as well, but it's really got worse during the pandemic. And this is now putting upward pressure potentially on inflation and interest rates. So unless we get that productivity growth going again, wages will contribute to higher inflation, higher interest rates.
And so, but just on that point, what can Labor do to try and improve productivity, this year? I mean, it's such a long-term prospect.
Well, it is. And Jim Chalmers did rightly say this week he can't just snap his fingers and increase productivity overnight. But there's things that they maybe potentially shouldn't be doing that is probably going to make productivity even worse at the moment. That would be probably, most economists would say, their industrial relation changes that they've pushed through and planning to push through more. That's unhelpful. But then over the sort of years ahead where you can actually make a positive difference on productivity, it's things like tax reform, slashing red tape, deregulation, making the economy more competitive as well. So businesses are facing more competition and pushing downward pressure on prices as well. But all that can't happen overnight. But the industrial relations changes are probably the biggest risk at the moment in the short term to the economy in terms of wage pressures.
Yeah. Look, we saw new data out yesterday that shows the economy grew by just 0.2% in the quarter to March. This is really concerning. Matt Canavan, you asked a question in Senate estimates just a few weeks ago about whether stagflation was a risk. You were told by senior Treasury officials that it was only a slight risk. Are you becoming more worried about stagflation in the second half of this year or even next year?
Well, I am if nothing's done about it, and I was a little surprised myself that the evidence was only a slight risk. I definitely think the probability of it is much higher than that, and the data, as you mentioned yesterday, shows that. I mean, we're only growing that 0.2% is only happening because we're importing about 2% extra people every year right now through our migration intake. So without that migration, we'd actually already be potentially in the recessionary zone. And of course, we've got very high inflation. So those two things together, high inflation, increasing unemployment or lower economic growth, means stagflation, and we don't want to see that. But they're not seeing a government that's trying to act and respond to this. I mean, the government basically has zero productivity agenda. Do you remember the job summit they had only 6 months or so ago? It seems like a lifetime away now. They didn't even invite the Productivity Commission along to that jobs summit. They're increasing taxes. They're regulating the energy markets. John's mentioned the industrial relations changes. There's no real agenda here to increase productivity, yet we had the absurd situation this week where we did have this productivity bomb, slow and stagnant economic growth, high inflation. We had this spectacle of the Treasury heading up saying his solution, what he's doing this week, what he's focused on, is banning cheques in 2030. I mean, where is Jim Chalmers' priorities right now, and why isn't he focused on doing what he can to help the Reserve Bank governor get inflation under control and lift productivity growth?